the light data is helping to some degree. You've got the yield down below 2.2%. You've had all that Treasury refunding this week, so the big supply is out of the way. The bond guys should be in relatively good shape. So we were all hoping, the bulls were hoping certainly, that if you broke out of this narrow range, you'd inspire some short covering, some follow-through, some sideline money. None of it has come about. This is a very, very disappointing breakout, and it may bode for the fact that we're not really breaking out, we're just staying at the top of the range.
Just staying range-bound, which has sort of been the story all year. I guess we should look at, though, the resilience of this market, Art. That was the 7th record close in 2015. It came at the same time as weak retail sales, economic data misses, this bond rout, the fear of higher interest rates. I mean, the worry list goes on and on and on, and yet we continue to make new record highs.
Well, the bad news is good news theory has been around for a while, and that's staying the hand of the Fed. You know, you and I have discussed before that Stanley Fischer is going to be a very big influence on the FOMC, and he wants to introduce surprise into the game. He wants the markets not to feel self-assured, and he thinks that will cause the markets to begin to pre-discount things. So he will be pushing the FOMC to try and at least appear to be ready to raise rates this year. And the soft data then makes the market feel better.
You've called it an iron ceiling. You talk about the top of this range. Are you saying we've not broken through? The iron ceiling is still there?
Well, apparently we haven't broken through significantly enough to force the shorts to cover or to get some of that sideline money to come in. Fischer is going to try and push the FOMC. So one of the difficulties will be that the Fed speakers, as they come on, will try and give a hint that, wait a minute, even though it's data dependent, we're still at the ready. And so I think you can expect that to be kind of a pushback on the market.
I know we're out of time. I just want to ask you one other question. If you look at the economists, they all think the majority there'll be a September rise, as is in the Heard on the Street column today. If you look at the market, the futures is not saying that at all. And maybe it will be if you get a rate rise at all so far this year. If the market is right and they don't pull the trigger, can the equity market rally substantially from here?
Well, I think obviously it can, provided the earnings remain there, whether it's through financial engineering or not. So I'm in the camp that thinks they may not do it this year.